It's Saturday morning at 10 a.m., so you know what that means. It's time for What's Up, Ocala? With tens of thousands of viewers every month on our YouTube channel and millions so far on TikTok, we are joined by our host, local owner, and broker of Great Expectations Realty, Andrea Praber.
Good morning, everyone. My name is Andrea Praber. I am the host of What's Up, Ocala. And joining me today is a very good friend from Guaranteed Rate. Why don't you tell everyone who you are and what you do?
Absolutely. My name is Byron Zonin. I am the Vice President of Lending for Guaranteed Rate, pretty much for North Central Florida. And I manage most of the areas to include Ocala, north up into Gainesville and across Central Florida as well. So what that means is that I help a lot of our loan officers and a lot of our customers make their way through the lending process, especially in an environment like today where it's a little more difficult. So I'm really a helping hand.
You really are. In fact, we were chatting during a sales meeting and we were playing a Stump Byron, basically. He didn't know we were playing, but that's what we were doing. But we were talking about, amongst us, about something that has started to show itself in the marketplace, and we haven't ever seen it. I've been doing this for nearly 20 years now, and it's not something I personally have seen in the markets because of what they were. But so many MLS listings are now saying that there's a possibility of assuming a mortgage, which is great. And I've even thought, hey, that's a fantastic idea. But I needed somebody that's actually done this or seen this in a prior market, somebody with experience to walk me through it. So that started a whole conversation. We started getting into the nitty-gritty of it, and I was flabbergasted as to some of the ins and outs and what you brought to the table with that. So I kind of wanted you guys to hear about this and really figure out some of those details before you got too far into a deal where you may not get what you think you got. So if that's basically what we're doing today. We're talking assumable mortgages, right? So tell us about it. What is an assumable mortgage and why is it hitting the market right now?
Absolutely. So what's really ironic is that right before you called me, or before I was put on the spot and asked about assumable mortgages, I was getting that call probably 2-3 times a week from other real estate agents across Florida. And what's interesting about it is that there are a lot of there's a lot of bad information out there on the streets about the program, and there is some information, but for the most part, if you try to find out what it really is, you're not going to find much.
Correct, because I couldn't. I really wanted to be able to provide that information, or at least, see if it's something that we can utilize in this kind of market. And it was just, I don't know, I just felt like I was chasing my own tail. It was not helpful.
Absolutely. So traditionally, whenever we're talking about assumable mortgages, usually most government loans such as FHA, VA, or USDA will have an assumption clause. And what that means is nothing more than under certain circumstances, you can take the terms of the loan that the seller currently has, and you can assume that mortgage. Basically, you're taking over their mortgage, and you're going to continue making the payments on that mortgage.
So the big question that everyone is saying is, well, great, you can assume that mortgage, which will probably be at maybe 2 or 3%. It sounds great. But the price of the home is normally much, much higher. What their asking price is much, much higher than that assumable mortgage. So what do they do in that circumstance, theoretically?
Absolutely. And that's a great question. And you're actually the first one that brought that to my attention, or actually asked the question. A lot of times what attracts people is they think that they're going to just assume that mortgage and they're not going to have to pay the difference between the seller's balance and what the actual sales price is, and that's not correct. So what you have to do is you have to come up with the difference between the sales price and what the current balance is that the seller has. So, and I'll go through a small illustration here in a few minutes. But the bottom line is that you're going to have some cash into the equation. Now, that cash can be your cash, or you could potentially do a second mortgage. And what's important about that is the terms on the second mortgage are not the same as they were in the first mortgage. In fact, Second mortgage rates are much higher than current market rates. Second mortgages traditionally have a term of up to about 20 years, and that loan has to be underwritten and gone through the underwriting process.
And this is really important because the amount that they're asking for the house may be significantly higher than what they still owe on the house, because the houses were selling when the rates were at 2 or 3%. The house prices were maybe $100,000, $150,000 for this area. That was the median house price. And now those exact same houses are closer to $300,000 or $400,000, and they've had all that time to pay down the mortgage as well. So it's significant.
That's correct. So that's where you really need somebody in your corner. You need to have not only a great real estate professional in your corner, but you also have to have somebody that understands the process, understands what goes into this to help you make the right decision. So with that being said, one of the things that you have to calculate when you're considering an assumable mortgage is going to be what your blended rate is. Your blended rate is going to be the blended rate between the current first mortgage, which we'll just say in this case is 3%, and then your second mortgage, which might be 10.5%, maybe 11 or even 12. Now, what's important about that is that if that first mortgage is a very small balance in comparison to the second mortgage, your blended rate is going to be much higher than what you think. And a lot of times we as humans get into a situation where we think that lower rates the best, it's going to yield me the best payment. Well, it will just on that first mortgage, but you also have to take into consideration the second mortgage so that your total monthly housing expense is factored into the equation when you're making a decision to buy that house.
So is an assumable mortgage even a good idea?
Yeah, in a lot of cases it is, but not in every case. And I'll give you a quick idea of what I'm talking about here. So if somebody just bought their house, maybe in, we'll say 2021, or it's early or late 2021 is probably the best equation, and they have we'll say a 4.5% rate.
Okay.
Well, if the market rates are 7.5% today and the appreciation on that specific property didn't go up a lot, or the seller is trying to move the house because they're moving, and you get a good deal on the purchase price of the house, the spread between the current balance and the actual purchase price might not be a huge difference. In those cases, it might be worth it. Or if the seller or the buyer has a lot of money down and they were going to put the money down, then they already had it factored into the equation to put that amount of money down. On the other side of things, if the housing values in that area went up a lot and the spread is significant, it might not be the best or the most advantageous for the buyer. If you'd like, I have a scenario that I kind of put together.
All
okay,
right. Get your paper and pen.
All right,
we're gonna do this.
So what I did was I just ran across some numbers because on the surface it's going to sound like the assumption's the way to go, and you guys can think through it and let us know what you think. So, for example, today, if a contract sales price is about $325,000, but the seller paid $175,000 for that house, we'll say a little over 3 years ago, and we have to define what kind of loan they did too, because the loan makes a difference. Back a few years ago, mortgage insurance or the monthly mortgage insurance on an FHA loan is more expensive than what it is today. And you have to factor that into it, whether it's better to assume that loan or take the new loan at the higher the higher interest rate with the lower mortgage insurance. So with that being said, the base loan amount would be around $168,000, and a total loan amount about $171,800 and some odd dollars, with the upfront mortgage insurance. The base payment on that is only $871, and the mortgage insurance is about $121 per month. And that's off of an 85 basis points mortgage insurance. Now, I don't want to get off track here.
Too far
I don't
want to
get
hole, okay?
Right. So
it's a basic idea, okay? So that they don't.
Right.
We're not going too far into, because
So
he can take you down a rabbit hole, okay?
Right. So what we're going to do is we're going to calculate what the current balance would be 3 years down the road is about $162,000. So you'd have to make up the difference between the $162,000 and the $325,000 purchase price. So that's $162,000.
Okay.
Where does that money come from? Well, the two options: the borrower puts that money down, which you tell me, you're probably better at this than I am. Do you see a lot of people that have $162,000 put down besides your cash buyers?
Yeah, I was like, if they've sold a house with a lot of equity, that's the only time I see it. But normally, no, I don't see a lot of people with, hundreds of thousands of dollars to put down on a house at that price point. Sorry.
Right.
Sorry. Oh.
So whenever we were talking earlier about the second mortgage, if we explore that route, second mortgages are going to be a little more conservative as far as loan to value, and traditionally they're higher in interest rate. So normally you're looking at about a 90% loan to value on a second mortgage. So that would mean they would still have to come up with 10% of their own money. Now, in addition to that, let's say that the interest rate is only 10.5. And I know I say only, but it could be higher than that on a second mortgage in today's environment. And the terms are usually up to about 20 years. That would give us a payment on that second mortgage of $1,303.
Ouch.
Now let's think about this for a second. You got the first mortgage payment plus the second mortgage payment. We're coming up to around $2,295 a month on that $325,000 purchase, and still have to put 10% down, which
Ouch.
10% is $32,500.
This is starting to feel like what I normally tell people when they go into, maybe doing maybe my credit's not that great, so I'm going to go ahead and get a house, land contract or something like that, or owner financing, and I'm gonna try and find an easier way or a shortcut. This is starting to sound like one of those deals where I'm like, look, it's gonna cost you more in the long run. Just do the regular way, and so what would the same amount be if they just did a regular FHA and for the 325?
I knew you were going to ask that. So I put together just a quick number. If you were to purchase a house for $325,000, and I did I think it was 7.75 roughly.
Okay.
And that's a good solid rate in today's market. You can do an FHA loan at 96.5% loan to value, purchase price of $325. That would give us a loan amount of $319. Long story short, we want to talk about payments, right?
Mm-hmm.
That would give us a total payment of $2,432. But the difference between that and the assumption with a second mortgage is that you're only putting 3.5% down. That's a huge difference. And the payment difference is between $2,295 and $2,432. Now, that's where you have to have a professional in your corner to help you with deciding on what you want to do. Now,
we went into, he's not even giving you the catch, and that's what really got me. And the catch is, for these assumable mortgages, for that second mortgage and for the assumable, how exactly are they supposed to do that? Can they just come to you and say, hey, this seller is saying that I can assume a mortgage. Can you go ahead and do that for me?
No, you can't. And in fact, you can't go to a lender to process the assumption. What you need to do is the seller is going to need to provide the listing agent the information for the bank that they're working with, or the bank they have their mortgage with, correct?
Because it could be anybody. They could have started with one and it been sold a few times.
That's correct. So then what happens is, and realistically, the buyer should be doing most of the legwork, because they're not going to talk to you as the listing agent without you having some kind of authorization from the buyer, from the seller. In addition to that, sometimes they still won't talk to you and you have to conference them in. Now, I'm not sure if you've had the pleasure of calling to...
No.
Okay,
No.
So let me tell you what happens. You call into the servicing number and you will be transferred several times. In fact, for preparation for today's call, I actually did that.
Did you really?
I sure did.
How did it go?
At Great Expectations Realty, we believe that you should expect more from your real estate experience. When you hire a realtor to sell your home, you should expect experienced advice on staging your home, professional photography, aerial photos, virtual video tours, and a national presence online to advertise your home to the largest pool of buyers. Your realtor should communicate from start to finish. And always remember, this is your home. You are in the driver's seat. We believe that if you aren't happy with our efforts, you should be able to fire us. We don't have cancellation fees, and our sellers never pay transaction fees either. Call Great Expectations Realty at 352-817-9160 or go online to greatexpectationsrealty.com to get your free analysis of your home's market price. Great Expectations Realty. Expect more from real estate.
But the challenge is that if, I consider myself somewhat experienced. I've been lending since 1995. I've been managing since roughly 1996. I've had huge teams over the years. And, when I called the servicing departments, what I found was a lot of people didn't understand what I was asking. Mm-hmm. And I would be transferred around several times. And I feel that the questioning that I was presenting was pretty straightforward. I would like to find out how I can have an assumption processed. I even called my own servicer. I have a VA loan on my property, and
you really went through with this. That's awesome.
I did because I wanted to find out how difficult it was for the average consumer, and I would absolutely encourage everybody to explore the option. If you have an FHA loan, VA loan, whatever, explore the option because in a lot of cases it is a great option. And then in some cases it isn't. And to make the phone call, it could be worth a little bit of legwork to do that. Sure. In fact, to sell your property, that might be the edge that somebody needs. They find out, hey, there's an assumption here. Let's go look at the house. They look at the house, they found out the assumption process, and they run the numbers. They say, you know what, maybe there's a better option for me. So it's absolutely a great idea if a house or a loan is assumable, to add it to the listings like most agents are.
It's not a bait and switch. It is possible and it should be advertised, but that's not the end of the story. There is definitely a lot more to it.
Absolutely. I would advertise it. But there's something also that we have to consider for the seller. And the seller has to make some decisions as well.
Okay. Like what? So
the first thing is that if the seller does offer an assumption, say they have an FHA loan, mm-hmm. There's a process you have to go through, and you have to make sure that the assumption goes through. You can't just transfer title without having it formally done with your title company, with the servicer of your current mortgage, and going through it as a typical standard purchase. For example, you as a buyer's agent, you would write the contract. The listing agent would be involved, with the listing. And, there'd be a normal title company, and then the mortgage company or the servicer would give you a list of things that you need to do in order to be able to process that assumption.
I'm already kind of feeling like if they don't do their due diligence and make sure, they may end up still being on the hook for that mortgage.
Ah, there you go.
Yeah.
So if you don't hear anything else I say today, this is the most important piece. Get a release of liability.
Okay.
Period. Release of liability. Okay.
From the servicer.
Yes. When you go through it, there has to be a release of liability. Otherwise, you're right. There's a little clause in your FHA loan package, or even your VA loan package. It's the FHA VA addendum, and in that package, it specifically tells you that until you have your release of liability, you're on the hook for the mortgage. So if the buyer buys the house and you'll go through the proper processes and you don't have it released, they default. Guess what? You're picking up payments.
That is terrifying. Well, it gets a little bit more spicy for VA though, because VA is, if I were looking, I've never been a service member, and I appreciate everybody's service, but if I'm looking at a house and it says assumable mortgage and it's a VA loan, could I still assume that mortgage? And then what happens to that person that now wants to buy a house and use their VA benefit?
Oh my goodness. So this is a great question. I've never had this question, but this is a very important question. And I'm going to go through it as
keep this simple.
I'm going to keep it simple. Okay. So what happens is, say you're buying my house, mm-hmm. and I offer an assumption. What's going to happen is, as the veteran, and you're not a veteran, I have the choice. I could actually give you my eligibility to process that loan.
Well, I appreciate that, but
or I could say, you know what, you don't have eligibility. We're not doing this.
right.
So as a veteran, I would go back and say, I'm only going to offer this to, people that have qualified benefits.
Right. Yeah.
Because on the flip side of this assumption is, as a veteran, if I give you my eligibility and, you take over an assumption on my property, if you default, even if I get a release of liability, you default, it's charged against my eligibility. So if I want to do a loan in the future, guess what? It's charged against my eligibility.
Well, you wouldn't be able to use it either. If you give me that, which I could see that happening maybe, for a family member or something, if you wanted to, but it's not my benefit. I'm not a veteran. I shouldn't have it, truthfully. Personal opinion, sorry. But if for some reason, you need to sell the house and we need to get this done and you go ahead and do, you then can't go and purchase another home with your VA eligibility, right?
Well, that's a great question. That's a whole nother day, a whole nother topic, but I'll give you the short of it. Just because you have one VA loan does not keep you or prevent you from having another VA loan. There are calculations that are involved, and whenever you do a loan, there's a certain amount that you do have eligibility for. For example, if I put a good amount of money down on that, then I would still have eligibility left where I could potentially buy another property. But maybe on your next show down the road,
possible.
If you invite me back, we could talk about that.
Awesome. That is so great. So, all right. Do you have anything else for us today that you want to? Because, I've been kind of grilling you and playing, Stump the Byron, and that's not really fair. So what else have you got on here?
So there are opportunities, and I want the audience to know that just because it's not a government-backed type of loan, in certain circumstances, other loans can potentially be assumed. So it's always worth asking the question. If you look at a conventional loan package at closing, it'll say this loan is not assumable, right? Mm-hmm. But that doesn't mean that there aren't certain circumstances where a servicer will consider an assumption. For example, if you have a conventional loan and you're the heir to an estate, that's a circumstance that you may be able to talk to the servicer about assuming that loan. Or maybe through a death or divorce or some type of special circumstance. So in the event that you're in a position where maybe you have a family member that's owned the property for forever, reach out to the servicer, and in some cases, they'll actually have procedures to where you could potentially assume that mortgage. Now, we talked a lot about assumptions, but the one thing we didn't talk about was just because an assumption is offered doesn't mean that somebody qualifies for it.
Oh, yeah, there's that too.
That's correct.
So how do you know if somebody qualifies or not?
Oh, it goes through a standard underwriting process, just like every other loan. So the key here is that if you're doing it with a second mortgage, not only does the servicer now got to add into the equation the new mortgage that you're assuming, they're going to have to add in that second mortgage as well. So what I went ahead and did was in my calls to the servicers, I asked them to send me an assumption package. And in the package, it goes into detail and it says, fill out the application and mail it to a mailbox. Right?
That's not really how that's weird in today's real estate world. Just letting you guys know that I don't think I haven't had to mail anything into somebody and have a wet signature in years.
That's correct. I agree 100%. And that's why I brought it up, because it's important, because this isn't going to be a standard 30-day turnaround time. Oh, no. It's going to take much longer. The servicer told me anywhere from 45 days is a minimum up to 90 days. Oh,
that's good to know.
It is.
Especially as a real estate agent, if we, write a contract or something, we need to know it's got to be 90 days.
That's right.
Or listings even, we need to make sure that information is in there. So, wow. So is this because we have not had Assumable? Is this basically how it was done? Maybe, when was the last time? 80s?
It's been a while.
So maybe they just haven't updated their process and they're using that same process from back then, or what's going on with that? That's weird.
Well, that's a good question. When I called and I got the assumption package.
Oh, there it is right there. You got it with you.
I got
oh,
it.
wow.
I brought it with me just in case I was asked this question. And it says return documents and a check to the following address, and you mail it in.
Okay, that's also not really done anymore. So, okay.
Yeah, do people even have checks?
I don't know.
Because you'd have to go to the bank and get a
do
bank
with it.
check.
That would be about the same as cash. Like I mean, maybe, for the rental side with property management, we take checks, but half the time they don't even know how to fill it out. These young people are like, a check? Like, don't you do debit? Could I Zelle it?
Right. Well, the other thing is it tells you to mail the whole application package to them, and then they are going to mail you back a disclosure package.
Oh,
so
fun.
I'm hoping that, and of course with the assumption package, they don't give you really a whole bunch of information. There is a phone number, the same servicing phone number that I called to get the package, and I'm sure they're going to send you the package out. You would hope the question would be, is there something that can expedite the process? Do you at least have email? Can we upload it to a portal? Can we, I don't know, even fax it? I don't even know do people even use faxes anymore? No, don't ask for fax then.
No, it's very, very rare that you have to fax something. And I mean, if I have to fax something, I fax it from my phone. I literally take a picture of the document and use an app.
Right.
But yeah, no, this is kind of crazy. You know what this reminds me of is it reminds me of a short sale.
I do remember short sale processes too.
Yes, this reminds me very much of like you guys seriously. It's a lot of paperwork he brought in this packet, so it does kind of remind me of more of a short sale procedure.
It does.
Having the extension of time needed and making sure and getting approval through the servicer and stuff. That's interesting.
Absolutely.
Interesting.
But don't let it intimidate you if you come across the perfect transaction.
Okay. So we're looking for unicorns basically.
Potentially.
Potentially. Okay. So just because it's advertised Assumable does not mean that it's the best thing for you, because there may be a much better option after talking to your lender. And B, it's going to take a little bit more time and a lot more paperwork.
Yep. And remember, if you are the seller, no matter what, get a release of liability. If you leave with nothing more than that today, get a release of liability.
Now, you've been doing this for several years. We're going to do many years, but we're going to say several years.
Right.
How many Assumable mortgage have you seen gone through?
That's an interesting question. I've never seen one go through.
Really? Yeah. I've never seen one go through. But...
Now, we don't process them because you have to go to your servicer, obviously.
Right.
But anybody I've ever talked to, I've never heard of anybody doing a successful one. Not saying that it's not being done, but usually people will.
Just the market.
Yeah, people will call me. I get calls all the time about, questions regarding stuff that's off the wall. And the truth is that most people that I've talked to have never completed an assumable mortgage. I don't know of anybody that's completed one. Again, not saying that it's not the best option for someone, because it could potentially be, but in my experience, I haven't seen it.
In my experience, neither. It's never even been a question because we had such low rates, or nobody could qualify to get a mortgage back in, during the crash or whatever. So, but my grandmother was in real estate. She was a broker here in Florida for many, many, many years. She's the one that actually got me to go and get my real estate license, kicking and screaming at one point. And she was the one that I remember her talking about assumable mortgages in, the 70s and 80s because the rates were so high at that time, and that's really what we're seeing again. So I think it is something that's going to be a little bit more common.
Yes.
But I think they definitely need to work on their process. That's for sure.
I think that the one thing we have to keep in mind, though, too, is what was the appreciation rates during those time frames when the rates were in the double digits in the 80s?
That's true.
We have a different dynamic, especially here in Florida.
The only thing that stays the same is change. So, something like that. So thank you so much for this information. I so appreciate you coming in and explaining this, because it's above my pay grade. It is way beyond anything that I would try and explain myself. And the amount of research that you did on this topic is just absolutely amazing. So we really greatly appreciate that. And I want to give a huge shout out to Guaranteed Rate for coming in and answering that and just being so available to us as a resource, so that if we do have a question about that, we can go to you and ask. That's so helpful to have those kind of people in your corner. So thank you.
No, thank you. I appreciate you inviting me on the show.
You've been listening to What's Up, Ocala? Follow us all week on Andrea Praber's YouTube channel and TikTok. We'll see you next week at 10 a.m. on What's Up, Ocala.